Wall Street just made crypto easier to buy than ever, and Bitcoin barely moved. On Thursday, E-Trade opened spot trading in Bitcoin, Ethereum, and Solana to eligible clients. The same day, Rowe Price launched an actively managed product that can rotate among multiple crypto assets. Ethereum then beat Bitcoin over the weekend comparison, while Congress held another major crypto hearing without passing a law. 4 headlines, 1 contradiction. The gates are opening. The money is not exactly stampeding through them yet. Start with E-Trade because this change is much bigger than adding 3 colorful buttons to a brokerage page. Eligible United States clients can now buy, sell, and hold Bitcoin, Ethereum, and Solana through E-Trade. The service runs 24 hours a day, 7 days a week, and the positions can appear alongside a client's stocks and funds. That removes a lot of friction. A user no longer has to discover a separate crypto exchange, create another login, learn a new interface, and mentally split a portfolio across 2 worlds. Crypto can now sit beside the retirement account and the index funds like it finally got invited to the family dinner. But the fine print matters. The crypto account is a separate linked account provided by Zero Hash. Morgan Stanley says it does not transact in or custody the digital assets itself. The coins are not protected by FDIC deposit insurance or SIPC securities coverage. E-Trade lists a commission of 50 basis points, which is $5 on a $1,000 trade, with no added spread or markup. And transfers of supported crypto into the account were described as coming later, not as a launch day feature. So this is not self-custody, it is not free trading, and it does not turn a brokerage account into a magic wallet with a seed phrase hidden under the keyboard. What it does is make access boring. That is important. New financial products often become large only after they become boring enough for normal people to use without feeling that they accidentally joined a cyberpunk role-playing game. E-Trade is selling convenience and a familiar name. In an April survey cited by Morgan Stanley, the most common top concern among investors choosing a crypto platform was an established company they could trust. That tells us what Wall Street thinks the next customer wants, not another token with a frog wearing sunglasses. One dashboard, one relationship, and somebody recognizable to complain to when the button does not work. Then Rowe Price took the idea one step further. Its new product trades under the ticker TKNZ. The company calls it the market's first actively managed multi-token spot exchange-traded product. It began trading on the New York Stock Exchange ARCA on July 16th. The eligible universe can include Bitcoin, Ethereum, BNB, XRP, Solana, Hyperliquid, and other qualifying assets. That does not mean every coin receives the same weight. It means professional managers can decide what belongs in the portfolio, how much belongs there, and when to rotate. That is a major change from the simple Bitcoin product pitch. A single asset Bitcoin product says, essentially, here is Bitcoin in a wrapper. TKNZ says, give us the selection problem, we will decide which parts of crypto deserve exposure. In other words, Wall Street is not merely opening the gate, it is offering to choose the passengers. Rowe Price reported $1.89 trillion in client assets at the end of June. This is not a crypto startup trying to look institutional by renting a marble lobby for the press photo. It is an 85-year-old asset manager putting active portfolio management directly on top of spot crypto. The current management fee is 0.75% after a temporary waiver. It is scheduled to rise to 0.9% in June of 2027. That is much more expensive than many single-asset spot products, so the managers need to add enough value through selection and rotation to justify the extra cost. The structure also deserves precision. TKNZ is an exchange-traded product, but it is not registered as an investment company under the Investment Company Act of 1940. The issuer explicitly warns that its regulatory structure, disclosures, and risks differ from a conventional registered fund. That does not make it automatically good or bad. It means the familiar ticker is a wrapper, not a force field. The interesting part is what this does to crypto's old culture. For years, the message was do your own research. Now, one of the largest names in asset management is offering a product whose entire point is, we will do the research and rotate the bag for you. Some investors will love that. Purists may react like somebody just installed a concierge desk in the middle of a permissionless network. Now look at the market, because adoption headlines and price action are telling different stories. At the Sunday source check, Bitcoin was around $64,650. Ethereum was around $1,871. Solana was around $76.20. From the July 12th close to that snapshot, Ethereum was up roughly 3.6%, Bitcoin about 1.4%, and Solana was down just under 1%. Ethereum's relative strength is not happening in a vacuum. United States spot Ether products took in fresh money earlier in the week, and Robinhood launched the public mainnet of Robinhood Chain on July 1st. The new network is an Ethereum Layer 2 built with Arbitrum technology. CoinDesk reported that it was already processing more than $800 million in daily decentralized exchange volume at the time, much of it meme coin trading. Yes, meme coins. Wall Street opens a polished front door, and somewhere in the basement, a cartoon animal is still doing 300% before lunch. Crypto contains multitudes. But the serious point is that Ethereum can benefit when new platforms use it for settlement and network activity. That is a different demand story from simply listing Ether on another exchange. Bitcoin, meanwhile, fell below $63,000 during Friday's risk-off move before recovering into the weekend. The sell-off hit technology shares too, with renewed Middle East tension adding pressure. This looked more like a macro risk move than a sudden rejection of the E-Trade or T-Rowe announcements. That is why the lack of an instant pump is not proof that the launches do not matter. A new gateway changes who can enter. It does not force anyone to walk through today. Distribution is infrastructure. Price still needs actual demand, available cash, and the willingness to take risk. And then there's Washington. On Friday, the House Financial Services Digital Assets Subcommittee held a Clarity Act field hearing at Federal Hall in New York. Witnesses represented Nova Labs, Bullish, Wisdom Tree, and Coin Center. The location was dramatic. The legal result was not. It was a hearing, not a vote. The House previously passed the bill by 294 votes to 134. The Senate Banking Committee advanced market structure legislation in May, but as of Sunday's refresh, there was no official full Senate passage and no enacted clarity law. So please ignore any thumbnail that makes one gavel look like the entire United States legal system finished its homework. The unresolved bill matters because the private market is moving faster than Congress. Brokerages are adding crypto. Asset managers are building multi-token products. New chains are processing real activity. But the final federal division of responsibility between the SEC and CFTC is still being negotiated. That leaves us with the real signal from this weekend. Crypto access is becoming normal before crypto policy is becoming final. E-Trade lowers the effort required to buy 3 major assets. Rowe Price turns coin selection into an institutional service. Ethereum is showing how network activity can create a separate demand story. Congress is still arguing over the rulebook. The floodgates are open. The water level is still the metric that matters. Watch 3 things next. First, whether eligible brokerage clients actually fund and use the new crypto accounts. A launch announcement is distribution, not flow. Second, what TKNZ actually holds and whether active management earns its higher fee after costs. Third, whether Senate leaders put clarity on a real floor schedule. A hearing creates pressure, a vote creates policy. Nothing here is financial advice. But the direction is clear. Wall Street no longer needs to be convinced that crypto belongs on the menu. Now it has to prove that customers are hungry.